Okay, guys, so now we've gone into an extremely important topic now, capital market efficiency. Here you'll be doing EMH, economic, no wait, is it EMH? Yeah, EMH. Economic, efficient market hypothesis, right? This can easily be an essay question, quite a couple of slides. You need to know all this very, very well. Now, so what is EMH, right? Or what is the capital market efficiency? So you know share prices, right? Share prices go up, share prices go down. So we're going to look at a real life example of actual prices of securities. Now, when we talk about securities, we're basically talking about Bitcoin, crypto, talking about share pricing companies, mostly share pricing companies. Like the efficient market hypothesis basically is more of companies, right? Securities are companies. But just for demonstration purposes, we're going to do Bitcoin because it's easier to show because all company markets are closed now. So anyway, if you look at this chart right now, what you're going to see is movements. So when I say movements, if you look very, very closely, can you see the price is constantly moving as you speak? This is a share price. So let's say this is a share price of an actual company, right? Let's say Apple, for example, right? The share price moves constantly up or down. It moves up when it's very good. Like good news comes out about Apple, it moves up. Good news comes out about, I don't know, its income statement, its financial statement, it moves up. But on the bad news side, if you get news about something that is bad about the company, this share is gonna drop. Now, if we look at this chart, I mean, we can tell over here some bad news happened here. Check how the market crashed over here. Well, not crashed, but it went quite down. So probably some bad news about the economy happened that caused it to be down. Now, how does this whole thing over here relate to our efficient market hypothesis? Well, basically, the definition of the efficient market hypothesis says all the security prices, which is like the share price, so all share prices reflect public available information. So the price of this now is around $85,194. That price values this commodity or this security. This price knows exactly what happened in the past. This price knows what's currently happening right now. And that makes sense, right? Where right now, can you see how it's going slightly down? There's probably a little bit of bad news in the world that's making it go down. It knows all this, right? So that's the efficient market hypothesis, but there's different forms, and we're going to now go into that, and it's quite interesting. So, what makes the market efficient, right? When we're asking about whether a market is efficient or not, we are asking if the prices show all relevant information. So if we say the market is efficient, that price what I showed you now, it's showing everything, it knows everything that happened currently, right? All of information publicly. If the share price doesn't represent of a company good, like it's not good representation of the company, what it's actually valued, then it's inefficient, right? And we can be discussed now about why it's inefficient. Now, basically what this whole thing is saying over here, you cannot beat the market, right? Because see, beating the market is this. I'm looking at this now and I'm seeing it going down. Remember, I can predict it'll go down. If I predict it'll go down, I can actually make money, by the way. That's how stocks work. If this price is going down and if I buy or if I like sell it over here, sorry, buy over here, I'll make money, right? If I predict it's going to go down. But in reality, I cannot do that. I cannot predict it. If I'm looking at this pattern, it goes up, then it's going to go down. I cannot say just because it went up, it's going to go down. That could be true, but I cannot beat the market. This price over here has a brain. It knows exactly what happened. So I can't go to the past and say, oh, this pattern happened, now this pattern will happen again. No, the price is more clever than you. The stock is more clever than you. It knows exactly what happened in the past, so you can't beat the market, right? Now, efficient market responds to good news. If the market or if the share, like example like Apple, has good news, the share price is going to jump quick and go up. But inefficient market is like this red one. Can you see how good news what happens? It goes straight up. And when it's straight up over here, it goes straight down. That's inefficient. Why? It's an overreaction. everyone gets like, excited and all that thing goes straight up. But over here up, it's not a good value of the stock. The stock is overvalued. It's too high. So a lot of times it happens where like companies, there's slight good news and the price shoots up. That is why it shoots back down, because the price realizes, oh no, we made a mistake. We are over happy. So it goes back down. This is inefficient when it doesn't represent the price well of a share. Delayed response to good news is like, it's like in the middle of inefficient and efficient. It's going up slowly and stuff, but it's taking too long to go up. Good news was to go up where it's valued at, the good news, and stay there. Right? If we look at the chart, let's see if we can spot that. So, okay. So right now, can you see over here how it went up quickly when there was literally nothing happening over here? Is this efficient? Well, if it went up and this price over here reflected the share, the value of the company, then we can say it's efficient. But if this price was not efficient, and see how it went up there but it went down quick, that means over there on top was like probably overvalued, then it went straight down, then it went down again. So that's an inefficient market. I mean, look at this, right? These markets are going up and down. Now when you look at the forms, right? So there's weak form, strong form, and strong form. Weak form, now instead of security, I'm gonna put share, right? Because I think it'll be easier. So share prices reflect all in found. Wait, share prices reflect all information found in past price and volume. So weak form, it only reflects past prices and volume. So what we looked at the chart there, the price represents the whole graph, like a whole graph in the past. Now, this is weak form is called weak because it doesn't know like all the financial statements of the company, all like those information. So I can beat the market. Why? I can look at a financial statement and predict that the company is going to do very, very well, buy share when it's up, and I can make profit. The weak form, the brains of the share price, does not know the financial statement. It only knows its past price history. You see what I'm saying? Semi-strong security prices reflect all public information. So the price of the share knows all its company's financial statements. It knows all the news articles, public information. It knows its past history of prices. Now, semi-strong, it's hard to beat the market. You can't really do anything because it knows a lot of stuff. But the difference between strong form is strong form knows inside information. What that means. So security prices reflect all information, public and private. So see how none of these two reflect private information. Private information is inside information. Let's say inside the Apple company, you know that Apple will go out of business within a year. Now this will create a crash in the stock price. It's going to go down. So if you're a employee who's working there, and if you leak the news to one of your friends will be like, hey, this share price is going to go down. Let me sell all my shares now for a profit now. Your share price sells for a profit, you make millions. That's because you know something the market doesn't know. You know something people in the world do not know. You're going to profit from that. Inside information, by the way, is illegal. So let's say over here, see, let's pretend like this was a big crash that happened, right? So you over here, your friend tells you, hey, the share price is going to go down now. Now here you cannot see. But the friend says, hey, I know this share price is going to go down. That's the inside information. Because your friend now is going to sell over here and make such a big profit. And he's going to win. All these people here, they don't know that the share price is going down. They're going to take a loss. So that's inside information. So your strong form will have that information in the price. It already knows that. Now, the weak form, so we're still discussing these three forms. It reflects all past market information such as the price and volume, right? Very keyword over here is basically mispriced shares, and implies technical analysis will lead to abnormal returns. So technical analysis means looking at the financial statements. Technical analysis is past information. You cannot look at that and predict what's going to happen to the share. So that's a problem in weak form. Now, if we look at semi-strong form, it implies adopting technical analysis will not lead to. So whether you do technical or fundamental analysis will not lead to abnormal returns. You cannot predict the market with either one of them, right? Semi-strong form, you can only beat the market with inside information. And finally, strong form, prices reflect all information, including public or private. So insiders can earn abnormal returns. You can beat the market if you know inside information. And yeah, so so we discussed insider trading when you know something you shouldn't know. If the share prices are strong form, you can beat it. Even in semi-strong, you can beat it. And even if it's weak form, you'll beat the share price. You'll actually have an advantage. But yeah, all this is very interesting, and that's it for this topic one.